If you take an introductory finance class anywhere in the world, you will be taught one unbreakable rule: risk equals reward. If you want high returns, you have to buy volatile, dangerous assets. But when you actually look at the market data spanning the last 90 years, that unbreakable rule falls apart. Academics visualize this relationship using the security market line. In theory, this line slopes steeply upward. You take on more risk, you get compensated with higher expected returns. Yet the actual empirical line flattens out entirely. High-risk stocks deliver terrible risk-adjusted returns, while boring, low-risk stocks offer the best. If low-risk stocks are mathematically superior, it suggests the market is structurally broken, leaving a massive opportunity for anyone who can figure out why it's happening. To capture this mispricing, researchers formalized a quantitative strategy known as betting against beta, or BAB. The goal is simply to exploit that flat market line. Look at this chart comparing portfolio values since 1963. The dotted black line is the standard market portfolio. The blue line is betting against beta, and the orange is betting against correlation. They massively outperform on a logarithmic scale. Notice the gray vertical bars marking recessions. While the market dips, the BAB strategy remains robust, powering through downturns over 5 decades. This outperformance spans more than 50 years. It is proof of a structural exploit built into the financial system itself, not a temporary statistical fluke. The root of this exploit comes down to 2 distinct types of market players: constrained investors, like mutual funds, pension funds, and retail traders, and unconstrained investors, like elite hedge funds. Constrained investors have aggressive return targets to hit, but they are either legally prohibited or practically unable to use borrowed money, leverage, to amplify their trades. To hit an 8 or 9% return target without borrowing cash, these funds are forced into a corner. They have to overweight their portfolios with the riskiest, highest beta stocks available. When trillions of dollars in retirement and mutual fund capital blindly chase the same volatile tech stocks and high-growth names, it artificially inflates their prices. These assets turn into overpriced lottery tickets. Conversely, the safe, boring companies, the utilities, the consumer staples, are largely ignored by these massive funds. Because nobody is fighting over them, they sit on the market completely underpriced. Unconstrained investors like Warren Buffett recognize this dynamic. They step in to buy the exact assets that institutional rules force everyone else to ignore. The strict regulations designed to keep mutual funds safe are exactly what force them into terrible, mathematically inferior trades, and that creates a permanent arbitrage for the elite. To execute BAM, Step 1, buy a portfolio of low beta stocks. Step 2, apply leverage, multiplying returns until risk matches the market. Step 3, short sell high beta stocks, deleveraging to that exact risk profile. This market-neutral portfolio has 0 beta, insulating it from crashes. Success here relies on the mechanical extraction of the premium left behind by forced institutional flows, regardless of whether any specific company is actually good. This exploit isn't limited to equities. The leverage aversion anomaly operates across global asset classes, forming the mathematical foundation for what the industry calls risk parity strategies. Risk parity applies the exact same logic to bonds. Instead of holding a standard 60-40 mix of stocks and bonds, you take safe government bonds, apply leverage to equalize their risk against equities, and historically beat the traditional portfolio. But there is a catch. You cannot just set this and walk away. The strategy requires relentless active management, high trading volumes, and strict monitoring of borrowing costs to maintain that perfect equilibrium. In Panel A, the total BAB strategy requires a massive 206% annualized turnover, threatening to eat profits alive. But the parity column reveals the truth. Most cost-effective returns come from dynamically timing leverage, not just passively picking low-beta stocks. Consistent outperformance comes from buying what the herd ignores, mastering the mechanics of leverage, and systematically betting against the market's addiction to high-risk assets.